Lamb, and I'm with the Virginia SBDC Network. For those of you that are not familiar with our organization, the Virginia Small Business Development Center is a partnership program between the U.S. Small Business Administration, George Mason University, and local host institutions throughout Virginia. With 26 locations across the Commonwealth, we provide training and technical assistance to small businesses in their local communities. Our one-on-one advising services are available at no charge. Today's webinar, Key Benchmarks for Tracking Craft Beverage Profitability, is presented by the Virginia SBDC Network. We are recording today's presentation, and it will be posted on our website, virginiasbdc.org. Due to the large number of expected participants, everyone's microphone is muted and the chat feature is turned off. But if you have questions during the presentation, you can type those into the Q&A box, just like Chris did. We have also enabled the live transcript function, which you can show or hide via your own meeting controls. And now it is my pleasure to introduce the Virginia SBDC Craft Beverage Assistance Program Manager, Chris Van Orden.
Thank you so much, Sheila. Good morning, everyone. Thanks for joining us for this conversation today about the important metrics to track when assessing profitability in the craft beverage business. My name is Chris Van Orden. I'm the manager of the Craft Beverage Assistance Program here at the Virginia SBDC. The CBA program is designed to provide industry-specific guidance to Virginia's craft beverage sector. Today's conversation is going to be free-flowing, kind of look into profitability benchmarks. You can enter any questions that you might have in the Q&A function, and we'll do our best to answer everything either during or after the webinar. So I'm very excited to welcome back Chris Farmand, who's the founder and principal of Small Batch Standard, a financial agency built to serve the craft beverage industry. With a team of consultants, accountants, tax consultants, and industry experts, Chris helps breweries and distilleries deploy data towards improved operations. Today, I'll be asking Chris to share some of his insights on what producers should be tracking to ensure profitability. Welcome back, Chris.
Thank you so much for having me, Chris. I'm excited to be here.
Yeah, very glad to have you here. You're obviously the guy to talk to when it comes to profit. You got the hats. I like it. I think I might have one too from a conference. It's a good looking hat.
Yes. Yes, we've
Um,
handed out over probably 500 of these hats now, and so we still keep them coming because it's so important.
yeah. Well, again, really happy to, have you here today in particular, right? There's a lot of conversations happening right now
Hmm.
about, the sort of constraints, maybe some of the pain that people are feeling in the industry. And right, for sure there are headwinds, but I was hoping you can maybe level set for us in terms of what you're seeing with the many producers that you work with. And we can maybe speak kind of specifically about breweries because that's the biggest pool that you service, but
Sure.
I think a lot of these lessons are going to apply for everybody.
Yeah, so I mean, we're constantly gathering data and we're constantly publishing that data and putting it into our talks. And there is a lot of doom and gloom out there. There is a lot of media saying that craft beer is going through some major headwinds, and I would say it's probably not as bad as everyone thinks, for the most part, right? It's not as bad as everyone thinks. Uh, I would say of the pool of customers that we work with, it's the ones that are blocking and tackling at the most basic level that continue to remain profitable, sometimes are gaining profitability or are just holding steady, right? Holding steady as to where they are and getting comfortable with steady. And so when I say blocking and tackling, what I mean is just running a business at the most basic level, understanding their revenue streams, understanding the profitability within those revenue streams, sometimes making some hard decisions to cut costs in those areas and in those revenue streams, and trying to get those sections of the brewery or the business generating more profit where in other areas they may have to let go of additional profit. So at the end of the day, we're running a business, and that business takes just fundamental blocking and tackling in order to withstand these headwinds. I'm going to say that yes, craft is experiencing some stagnation, but stagnation doesn't mean catastrophic failure,
Hmm.
right? It doesn't mean catastrophic failure. It means that we just have to get comfortable with stagnation for a bit, and we know this is a cyclical industry and it will come back.
Yeah, yeah, and I think there's been so much growth in this sector over the time. Hey, maybe it was running a little too hot, and this is a
Hmm.
corrective. And I mean, people talked about maturing. Maybe we're at matured stage now, and yeah, there's nothing wrong with that. And before I go any further, I'm going to put a plug in. If you haven't read any of the small batch standard blogs, they're great. I know some of the things we're going to talk about today. We'll touch on some of them, but absolutely go there to go read different thoughts into some of these areas, both big
Sure.
picture and specific. So great to hear that even in a time of kind of contraction, stagnation, there are plenty of folks that are faring all right. Before we get into specific benchmarks, I was hoping that you could speak kind of generally about the sort of process of measuring performance as a small producer and why people who work with the industry are often reluctant to cite specific benchmarks for these, metrics.
Sure. Sure. I would say while craft may be labeled mature, it's still a very young industry. It's been around since the 80s, right? Small beverage manufacturers. And then we had a run up in the 90s, and then we had a big drop off in the early 2000s, and then we had the most recent 2010 run up. That's a young industry, timeline wise, and no one really paid attention to where are the guardrails for this industry? Who's developing the guardrails? Who has the data to develop the guardrails? And there are some organizations out there that group them into restaurants, which some of them are restaurants. Others group them into bars. Not really bars. A certain aspect of the business is bars, but you really have to look at a brewery for what it is, which is it could be up to 5 business units under one roof. So complicated set of operations.
Mhm.
And what we've done is we've looked at the operations and we always go back to following the dollar. We always go back to following the dollar. And where do the dollars come from? Where is the revenue generated from? And from those business units, we started developing various benchmarks. So I would say the benchmarks out there aren't really that robust because the industry's young and no one has really taken the time to comb through the data like we have. Um, I would say a low hanging fruit benchmark, if nothing else exists out there,
Mhm.
is most businesses run by their cash balance. And while I can't give you a good cash balance or a not good cash balance for your operation because I don't know the size, what I can say is how does your stomach feel at the end of the month, right? How does your gut feel at the end of the month regarding, you have payroll coming up at the end of the week, you have rent coming up. Is is this no sweat? Or is this, oh boy, we need certain deposits to hit on certain days? And
Mhm.
I would say that's the low end of blocking and tackling I'm talking about. Understanding the cash balance and kind of the cash flow cycle of
Mhm.
of your business. And it's so critical that every business owner, brewery, any business understands their cash cycle and
Mhm.
cash flow. From there, we can really start to dive into all the detailed benchmarks that we talk about, which is everything from looking at earnings and net income to various labor categories and so on and so forth to start dialing in to hopefully increase that cash balance at the end of the month.
Yeah, yeah, I think that's great. I mean, cash balance, that's a great gut check. And I think every business owner does that. So even if you don't feel like you are measuring it, like you're measuring it in a way, but a lot of this conversation's had to be a little bit more intentional, a little bit more thoughtful about diagnosing things, being able to take corrective action instead of feeling overwhelmed by like, okay, I'm having a hard time. Like, no, let's zero in on actual things that you can do to get back on track or improve things. So
Right.
maybe we could start with, some of the revenue side, right? Lots of measures related to revenue, but especially in an industry that has a lot of in-person visitation, a lot of revenues generated via tasting rooms and tap rooms. what do you
Hmm.
suggest people look at to assess their sort of position in the tasting room?
Yeah. So there's two benchmarks I want to talk about, and they're super easy to calculate, and they're a really strong pulse check of your retail operations. First is going to be taproom revenue per barrel. Okay, taproom revenue per barrel. And what this tells us is, are you generating enough revenue per barrel in order to pay for certainly all the expenses in your taproom operations, but in most cases, a majority of your expenses in wholesale operations?
Hmm.
And our range is $1,300 to $1,600 a barrel out of the tap room. The revenue per barrel in distro is far different from that. We can talk about that, but let's focus on the 13 to 1800 now, and the math on that. Like how
Hmm.
do we get to the math on that? And what what I'd like all the listeners to do is I'd like them to say, all right, we want to be at $1,400 a barrel. That's where we want to be, or $1,500 a barrel. But for our math, let's do $1,400 a barrel. And for us, we take a half barrel, a half keg, a half barrel keg, and we say that can generate 100 pints. I know it can generate probably a little bit more than that, but for easy math, 100 pints. So a full barrel is going to be 200 pints. All right. So if we say that we want to be at a $1,400 barrel range and we can generate 200 pints, 1,400 divided by two is $700. Excuse me, $7 a pint.
We're not there yet.
$7 a pint.
Yeah.
And we kind of anchor on the pint price. I know you have 100 different pours and you have 100 different combinations, but we really anchor on that pint price because we found that's the most common pour size. And if you can nail the pint price, really every other smaller pour is going to be exponentially more profitable.
Hmm.
Right? Is going to be exponentially more profitable. So if you want to be at $1,500 a barrel and you do that same math, you're now looking at $7.50 a pint. The way you determine it is really going to be market specific. Just two quick examples. I gave this a similar talk in Colorado, and people were asking me if these were numbers from 2012. I gave the same talk in Kentucky, and they said I was out of my mind because those are two very different markets and they're very priced very differently. So I'm not saying that $1,300, $1,400, or $1,600 is right for your market in Virginia versus Richmond versus somewhere maybe out
Hmm.
in the rural area, but this is just a guide. It's a guide range that you can start doing math and just see how far your pint prices are off it, but you really want to be between the $1,300 and $1,600 per barrel range.
That's great.
Okay.
That's great. Yeah.
So the second benchmark I want to talk about is this food to beverage revenue ratio. Okay. And what that says is how much are you selling food versus how much are you selling in alcohol beverage? And we like to see that somewhere between 50-50. That's our range is 50-50. And what I mean by that is if you're doing $1.4 million in sales,
Mhm.
we want to see 700,000 coming from food, 700,000 coming from beverage. And I understand that some of you are selling beer and wine and spirits, so we want to group it all together into beverage. And what this benchmark tells us is that we have a really good sales program because most of your plate pricing is going to be 2 to 2.5 times a pour price. Fill in the blank pour price, right? So what that means is that your taproom staff, your wait staff is really going to need to start moving into a sales mode in order to make up those poor sales to match food sales. So 50-50 is a range. If you're 60-40 or 40-60 one way or another, that's great. That's great. But if you're selling 80% food, 20% beverage, there's a problem.
Hmm.
Or vice versa. There's something that needs to be addressed there.
Yeah, finding that equilibrium is very important. Obviously, yeah, accounting for different models. You mentioned something I wanted to grab onto there, the sort of staff and the kind of getting them into sales mode and all of that. And
Hmm.
obviously, labor is a big cost center for producers, especially on the smaller scale, right, as a share of total cost. And but also potentially a big asset to deploy in promoting profitability. So what are some benchmarks that you use for measuring the performance of different departments in terms of staff?
Sure, sure. Yeah, as you mentioned, labor is certainly the biggest expense of the brewery, without a doubt. Your folks, and at the same time, you can't do it without them. Like this
Mhm.
isn't something that we can offshore, nearshore. Everything is made there and sold
Mhm.
there. It's an experience. So you need the team. And monitoring labor benchmarks are really critical. And when it comes to the tasting room, well, let me go bigger picture real quick. So we break labor into four categories. We break it into production, admin, outside sales, and then we call it tap room. Tap room originally was just your tap room staff, but really we may have front of the house, we may have back of the house, we may have kitchen. So
Mhm.
a bit of a breakdown of the various labor departments. And if we're focusing on the tap room today, and we're focusing on
Okay.
what that looks like, because we do have benchmarks for each of those categories, we break the tasting room into three categories, and that's no food, light food, full kitchen. And it's important to break it down into that area because your labor benchmark for no food, which is you're taking packages, prepackaged pretzels and popcorn and snacks and just displaying them and handing them to the customers, is going to be far less than if you're running a full kitchen. So the benchmark range, if you have no food, is 8 to 11 or 12% of total taproom sales.
Mhm.
Okay. The second category is going to be light food, and that does take a dedicated person to prep. I've seen some tasting rooms where the bar staff will run over and pull something out of a crock pot or put something in a conveyor. Our definition of light food is you need someone there running the food program, but it would be one person. It's air fryers, it's conveyors, not hoods and flat tops and stuff like that. So you're
Mhm.
putting sandwiches together, or you're putting pretzels and pizzas and empanadas through an air fryer or a conveyor, something like that. And that labor range is 18 to 22% of taproom sales. Okay, that's going to encompass your front of the house, your bartenders, and this one individual who runs the food program single-handedly, basically, and it can be done. And the final category is we pulled it from the restaurant association. It's labor involved in a restaurant associate in a full restaurant, and that's going to be 30 to 33% ish, something around there. We found that really well-run pizza kitchens or taco kitchens can get right below that 30% mark if
Mhm.
if labor is optimized and there's a really good kitchen manager or someone who has extensive restaurant experience is scheduling, is doing the scheduling. Um, Most of the time, though, breweries run at the higher end of all those ranges. If it's we slap together a food program and our cooks are phenomenal, but the original owners are trying to figure out the scheduling and the staffing and stuff like that, they tend to lean heavier on the upper end of those ranges, and that's eating into profitability.
Yeah. And it's important, right? If people are listening in and say, "Oh man, I'm nowhere near that." Well, it's time to dig in, right? This is why it's very good to have you here to, right, give people that temperature check of, are you way out of line with it? That's what's killing your profitability, right? It could be any
Absolutely.
one of these things. And then that gets you down to further diagnosis. Um,
Yeah.
we don't have to do a full dive into this, of course. I mean, there's a lot to cover here, but are there any other kind of labor related benchmarks that you want to highlight here? Anything that would be um, similarly insightful for people to just give themselves a
Yeah.
cut check?
Yeah, I would say across the board, production labor and admin labor usually come in line. And they come in line because when we're looking at taproom labor, we're benchmarking it against taproom revenue. When we look at production labor and admin labor, we're benchmarking it against total revenue. So those two levels get a reprieve, and most owners know the staffing required for their production. They know it. They typically not overstaffed. Outside sales is a big one. is a big, I don't want to call it a leak, but as wholesale continues to shrink, shelf space continues to shrink, your outside salespeople are costing more money. If they're not selling as much, they're costing more money. So we've got to take a hard look at what markets are we serving. Are we moving the needle in those markets? Can one person handle multiple markets now? Um, the ideal benchmark for outside sales is going to be 10% of outside sales revenue.
Hmm.
So if you're paying someone 50,000 a year base plus commission, we just take the base and we say 10% of that. It's going to be $500,000 in sales at 10% in revenue contribution to the business.
Hmm.
Most of the time we see this, it's between 15 and 20% is what the rep is costing. And that may be the absolute best that they can do,
Hmm.
depending if you're self-distro or working with a distributor or a combination of both. I think in Virginia you have to use a distributor, right? Yeah. I
Yeah.
think in Virginia you
Uh,
have to use a distributor. So
there's like Virginia Beer Distribution Company has been up and running for about a year, Virginia Wine Distribution Company, but there's a cap on the barrelage, that kind of thing. So it's, it's good to know that it could be, yeah, either
yeah.
way.
Okay. So I would say that that's the next biggest area to look at is going to be your outside sales labor and how how that plays to what that rep is contributing in revenue to the business.
Yeah, that's great. Yeah. It's all these different centers. It's good to know, hey, what are they contributing to? And I come from an admin area. I was never revenue generating, but I think it's important to know that, hey, there's certain people that you need just because, it doesn't matter how profitable they are if you don't have somebody who's
Yeah.
in charge of logistics or doing your filings or accounting, right? These are all things that need to happen.
Hmm.
So, um, I think now it might be good to talk about the sort of like profitability and some of the process things, kind of maybe on the production side, costing out, figuring out, hey, are you producing efficiently here? So can you talk a little bit about,
Yeah.
cost of goods and some of those other measures that you use for measuring production efficiency?
Yeah, that's a great question. And we don't do much consulting on the process and
Sure.
the production part of it because that we just look at the outputs. We look at the
Hmm.
outputs. And so sure, you can look at yield per barrel and try to increase the yield because that's going to mean more product to sell and
Hmm.
more revenue and more hopefully profit. Other areas to look at is sometimes a lab person or a shared lab person can really pay for themselves big time if
Hmm.
they're uh, catching errors ahead of time so batches aren't going to waste, or if they're able to have a really good yeast program and save costs there.
Yeah.
So a great lab department or shared lab department can be a benefit. I would say where we come in and have the most impact is around margins and wholesale. So you're making a widget, right? You're making a case of beer, you're making a keg or a half barrel or a sixtel or a 50-liter keg, and you're sending it out. Well, what do we know the profitability on that SKU? Do we know the margin on that SKU? And that's so important because historically we know that sixtels are your most profitable SKU in wholesale, and then come 16-ounce cases, then come 12-ounce cases, and at a dead last is your half barrel. Well, most breweries distribute half barrel the most, and they're just continuing to send this product out to market without knowing the true profitability. And that's where we really come in and say, hey, look, your highest selling style and SKU is currently costing you money to put it in the market.
Hmm.
That's a hard pill to swallow. That's a really hard pill to swallow, but it we can take that information and we can make decisions, and we can start to say, do we need to increase price? How can we reduce costs? how can we expand sales
Hmm.
and start to try to put that puzzle together in order to say distribution makes sense or it doesn't make sense. So that's where we kind of come in with product and we take all the inputs and what it costs to make the product. We add the various overhead and labor and other expenses that went into touching that product to come up to a final number and be like, I don't know if this is making you money. It doesn't appear so.
Hmm.
So let's brainstorm on how it can start making money.
Yeah. Yeah. I mean, that's in the end what this is all about. And I definitely know what you mean in terms of, right, you're making this liquid, you're putting it in different containers, selling it in different channels. I mean, on a per ounce basis, right, the difference between like a pint served in-house versus a half barrel keg in distro, that same ounce is huge gulf in terms of your profitability.
Yep.
Obviously, and different costs associated with that. And especially if you're line pricing your, right, easy blonde ale that's very based off with your double IPA that's 8.5% with all of
Yep.
these hops that aren't under contract. I mean, you're going to be getting absolutely creamed, and it's when you peek under the hood and you realize, like, yeah, hey, I'm selling this thing. It may move fast, and that's because I'm actually losing money on it. And well, you could say, well, yeah, I'm losing money per, but I'm selling a lot of it. Well, like
Right.
that's that's not what you want to hear. If you're,
Right.
um,
It's a scary truth, right? It's a scary truth that you have to face at some point. And unfortunately, the breweries that don't want to face it, sometimes it's too late when they uncover that truth. So it, tap room, there's lots of areas to slip and make up. In
mhm,
wholesale, there's not. It,
mhm.
it's really a steep learning curve and very small margin of. I have a graph at the end I'd like to share, if you don't mind, on my screen, if
Yeah,
possible,
yeah, I think
which kind of shows the a really good pictorial of tap room versus wholesale and that kind of stuff.
yeah, yeah. I think that should be fine. I'll let my colleague, if that's if there's any permissions that need to be given, it should be just fine to be able to pull it up. But
Okay.
yeah, I know it's I've seen some of your presentations over the years, and there it's can be very illuminating when you actually you have all this data from lots of different breweries and uh seeing what actually matters. Yeah. So as I mentioned, right, in the end, all this adds up to, hey, are you making money as a business or not? Right. I mean, that's
Right.
what this is. This is a business. No company is going to be, 10 out of 10 across the board, right? Due to all kinds of constraints, right? Depending on where your money comes from, your location. I mean, hey, you might be inefficient just because there's some local person who's making your life hard and you have to pay to do something, right? Whatever, you can't
Mhm.
be open as late as you want to be because of noise or all kinds of things, right? But hopefully people are coming out ahead when they're done with all the reckoning of their, balance sheet. So you mentioned, right, the sort of cash flow position being a great gut check. Are there any other metrics that you use to assess overall business health?
Yeah. Yeah, so I mean, well, let's just go with the bottom line, right? Let's go with net operating income or earnings. If most breweries that we encounter are using QuickBooks. QuickBooks Online is an accounting software, and QuickBooks has a line down at the bottom of your P&L called net operating income. And if your chart of accounts are set up properly, this is the number one barometer that we go by to see, hey, is this business generating enough cash at the end of the month to pay investors, buy
Hmm.
more raw materials, pay down debt, potentially invest in equipment, right? Is there enough cash left over to do one of those four things? Pay owners to and investors owners is kind of the same thing.
Hmm.
So we have a wide range of what that net operating income should be because just like you mentioned a minute ago, the profitability in your tap room versus the profitability in wholesale are so wildly different that we've actually created 7 or 8 silos of what that net operating income percentage should be. So I'll just give you an example. If you're currently doing 50% of your revenue in wholesale and 50% of your revenue in retail tap room,
Hmm.
that net operating income should be somewhere between, I'd say 12 and 14%. Okay. So if you're doing $1 million a year, 500,000 in wholesale, 500,000 in your tap room, I'm saying you should keep somewhere between 100 and 120 to $130,000 a year.
Hmm.
If you're not, there's a hole in the boat somewhere,
Hmm.
right? Now, if we look at one other end of that spectrum, which is if you're doing 90% wholesale, 10% retail, you should be keeping 1 to 3% a year. Versus if you're doing 90% retail, 10% wholesale, you should be keeping in excess of 14%. That's the profitability range. And that's the data that we have insights to and we're able to benchmark. But for most of the breweries we talk to, they're somewhere between that 50-50 range
Hmm.
of revenue generation. And that's going to be your guiding star, right? So many breweries today we meet and they're like, hey, we're, we were profitable in 24. We were profitable in 25. I think we'll be profitable in 26. We just aren't paying ourselves a whole lot. Right. And that's a big concern these days. That's a big
Hmm.
concern that you've been operating for 5+ years and you haven't taken a whole lot home. You've made a lot of good liquid, but you haven't made a whole lot, taken a whole lot home. Well, that net operating income number is a really good indicator of what you can take home.
Yeah. Yeah. I mean, in the end, yeah, I say this all the time. Hey, especially if you're early stages, maybe you're not paying yourself yet. Your budgeting needs to account for you. This is not a
Hmm.
charity. You're not going to be, doing this as volunteer work, even if you're not taking it yet. It needs to be part of the model, and it needs to be the goal to be
Yep.
paying yourself because, yeah, if you're paying everyone but yourself as the owner operator of a company here, um, you will not have a happy household if you keep doing that much longer. And the business should, if it's working properly, it should account for you. So
Yep.
yeah.
Yeah,
Um,
and we see that a lot, right? We see that where the owners forego a pay or say, hey, we're not going to pay ourselves for the second half of the year. Over time, that really starts to like mentally, emotionally, physically drain you. And yes, you should. You're putting in a ton of time, so you should be compensated for this.
yeah, absolutely. Well, if I think you should be able to share your screen if you want to pull up that
Yeah,
kind of visual. Hopefully, it will work for you here. You see the
yeah.
share button line?
Let me just go ahead and do this and share this. There we go. Okay. Can you see that graph?
It is pulling up. Let's see. Started. There it is. Yep, perfect.
Okay. Awesome. So I have like a few slides to share here if possible. If not, just you can stop me or we can cut it off or
Go ahead.
so we just unleashed our 2025 data and you're looking at some of the freshest benchmarks that I think we've spoken to two guilds about this. So you guys are the third. What you're looking at on the left is the earning or net operating income for tap rooms in our data set. And what you're looking at on the right is the distribution net operating income. We use the acronym EBITDA, but EBITDA and net operating income are synonymous if your chart of accounts are set up properly. Now, our data set is, I think, 82 breweries, all different sizes, anywhere from a half a million in revenue to 12 million, 1,000 barrels to 20,000 barrels, all at all regions of the country, and we've fully vetted the financials of these 82 breweries in our data set. What you're looking at on the left is the top end of our data set. They're earning 17% in their tap rooms. The lower end are actually losing 5%, but that fire line in the middle is the average of our data set, so 6%. And that falls in line with what I said kind of earlier. If depending on your revenue makeup, you're going to be somewhere between 8 and 20 something percent. And these are the numbers from our most recent benchmarking. On the right, you're looking at the distribution, right? So the average of our data set's losing 18%. There are a group that are making 11%, and that benchmark is 0 to or 1 to 8%. Um, Now, I will tell you the average in our previous benchmarking was negative 54. So breweries are doing something to cut the costs of loss in distribution. But this is really the way that we look at every brewery that comes in, is we look at the two or multiple business units and we go from there. Now, every time I give this talk and we show this graph, I always ask, what's the first question that comes to mind? What's the first question that comes to mind when you're looking at this? And if I was sitting in the crowd, I would be thinking, hey, what are the 17 and 11 percenters doing?
Hmm.
Right? What are the 17 and 11 percenters doing? And we've compiled a short list of items that they're doing, and we want to share that with the viewers if that's okay.
Yeah, please.
Is that okay?
Yeah.
Great. So yeah, if we look at this, right? So what we've done is we've put together what we call the brewery profit plays, and
Mhm.
it's three distro and three taproom plays that will begin generating more profit at your brewery. And the best part is I'm not going to ask you to hire people or buy equipment or take out more debt. These plays are what our most successful customers are doing, and they're doing it on a regular basis. Um, this is just a few examples of the plays that we've run here. And so beyond the 285 breweries we've helped, on average, we find $65,000 in tap room profit and 72,000 in distro profit opportunities. And there are two examples there at the bottom of live examples of two examples that we did for breweries in there. So what I'm saying is we want to offer the opportunity to run these profit plays with the listeners on this, and then the people that watch the follow up recording,
Mhm.
if they're interested, a free profit call. So if you pull out your phones and scan the QR code, you can jump in and grab some time with our consultants completely free to run one of these profit plays with your brewery.
Awesome. Thank you. Yeah, I appreciate you making that available to everybody that's tuning in today. It's really helpful for people to walk through this stuff. And I know it's there's a lot to tackle for folks, but talking to people who have seen a lot of it that have some of
Yeah.
those numbers and be able to tell. So
I, I know some of the daunting issues that come up with pivots or decision making is what is it going to cost, right? And
mhm.
and sometimes it costs a lot if it includes purchasing equipment or hiring a new staff or hiring a high level person, and other times it doesn't have to cost anything to make a pivot and begin
Mhm.
generating more profit. So um, that we understand that the time now is not to be investing in certain things. It's just what can we do with our existing resources to generate more profit.
Yeah, that's awesome.
Yep.
Well, Chris, thank you so much for your insights and your time today. Obviously, you've got lots of valuable things to add here, and it's refreshing to hear both some specifics mentioned when we're talking about benchmarks and right operational things rather than kind of costs inducing activities that people can take here.
Yeah.
Sure, there's lots more to talk about, but before I let you go, if you have any, do you have any kind of like fun or surprising metrics or benchmarks that you've uncovered in the course of your work that really is a good sign of kind of business health?
Um, here, so I would say that we were big on occupancy about 3 or 4 years ago, and we leaned on COVID. So with us, occupancy is rent and utilities. It's not just rent, and we set that benchmark as a stretch because we understand the profitability of your pints and your retail. So um, post COVID, a lot of rent went up.
Mhm.
A lot of rent increased substantially. There was a lot of shuffling in commercial real estate. And so we took an opportunity there to really shout from the rooftops, if you don't need the space, this is your time to give it back. And I think a lot of breweries listened and realized that it doesn't make a whole lot of sense to be manufacturing something when you're paying retail rent per square foot and vice versa. It's not easy to attract folks to the warehouses to drink anymore.
Hmm.
So there was a lot of right sizing there, and I would say that across the board, occupancy is now right sized, and it makes sense for most breweries. So that's a good kind of like shift that took a few years to digest and put into play, but really proud of all the breweries that made hard decisions to either downsize, give space back, or move operations into something that, financially made sense.
Yeah, no,
Yeah.
it's a great example of those tough decisions that people are making. But if that's what's right for the business, you may love your spot, but if it's not making the money, then it's time to let it go.
Right.
Chris, thanks so much for your time. Really appreciate you being here today and sharing those insights.
Thank you. Anytime. I'm happy to do it.
I agree. Thank you both, Chris and Chris, and thank you to everyone who joined us today. As a reminder, you're going to receive an email with a link to both to the recording. If you would like to sign up for upcoming webinars or access recorded webinars, please visit virginiasbdc.org/training. These resources are designed to be used in collaboration with your local SBDC advisors. You can sign up for a free and confidential session by emailing help@virginiasbdc.org or via our website. And we hope to see you all at our next session. Take care, everyone.
Bye now. Thanks a
Thank
lot.
you.